Okay, folks, we are looking at the intermediate term trading plan example. Now, what we're going to cover in this module is going to be just an example, like it states here. There's going to be certain aspects of this particular example of a plan where I can suggest that you could use other tools or applications, and where I note those, obviously, you can use the suggested mediums and tools at that time. It's not meant for you to use this as a specific trading plan. I'm not advocating that you take this and run with it, try to invest real money with it. It's meant to stimulate prudent decision making on your part, uh, determine whether or not you have the patience and faculties really to be a trader and follow a plan of this nature. And obviously, if we're talking about intermediate term trading, the duration of the trade is absolutely different than what most folks are doing in terms of Forex. By that means I'm referring to intraday and scalp trading. This is not very short-term trading. It's higher time frame premise predominantly, and your trades are going to take a whole lot of time to set up, and also equally more time to unfold to its completion. So this module will more or less demand a level of patience that probably the majority of traders will not have at the early stages of their development. All right, we're going to talk about the general market and the overall trading plan outline for trading intermediate term. Obviously, the time frame that we're going to be trading is the daily chart. Okay, the trading plan outline. Now, the time frame that we are trading in this specific example is going to be referred to predominantly the daily chart. And its primary focus in this plan is to trade the intermediate term price swings found on the daily chart. Typically, trade durations will last anywhere between several weeks to as many as months. Now, in this plan, we're going to classify bullish conditions and bearish conditions. Okay, and this is more or less the market environment that will facilitate buys and sells. First, we're obviously going to look at the bullish conditions. And typically, when you enter a seasonal tendency, when you would expect a bullish market, obviously that sets you on alert to look for turns or buying conditions in the marketplace that would facilitate long positions. We're going to be watching the interest rates, okay, and we want to be expecting interest rates to be moving higher and or looking for divergence, okay, in the yields to possibly indicate that we're bottoming out in the yields and we may be going higher. Because markets basically seek higher yields, that is going to create the risk on effect that we're looking for a bullish condition. Obviously, it goes without saying, if we're looking for a risk on scenario, the US dollar is going to weaken at this time frame. So we're going to be looking for topping formations or weakening of the US dollar on the daily chart. The treasury notes, okay, 2-year, 5-year, and 10-year, we'll be looking for those futures markets because we are going to be contrasting Forex trading with the insights that we glean from the futures market. The daily charts on 2, 5, and 10-year should be declining, and because there's an inversion of relationship between the yields and the futures markets, T-notes will be going down on your daily charts, while that indicates that the interest rate itself, its yield, would be moving higher. COT, this commodity tool that we use, commitment of traders, we're going to be looking for hopefully the commercials being a net long position, or if they are net short, we want to be looking for an aggressively lessening of their short positions. Okay, and you can see that in open interest. Sentiment, obviously, on the daily chart should be oversold, and the way we're going to be determining that is we're going to be looking at a daily Williams percent R. Okay, so that's going to be our tool to more or less indicate to us whether or not if the market sentiment is oversold or overbought. Okay, in this case, since we're looking for bullish conditions, ideally the sentiment should be oversold. Stock indices, hopefully at this time, are firming and or bullish. Okay, so in other words, you're going to be looking for some kind of failure swing between the major stock indices, and that would be at hopefully at a key support level. Commodities should be at this time bullish, and we would reference that would be to look at the CRB index, and it should be trading firm to bullish at a key support level, and maybe even looking for a buy pattern of some sort, maybe the optimal trade entry, something of that nature. When I say firm, it means indicating an unwillingness to go lower. Okay, and gold and oil, obviously, good benchmarks for the economy. They should be firm and or to bullish as well. Conversely, obviously, for the bearish conditions, seasonally speaking, there should be a bearish market environment. Seasonally speaking, that should set you on alert to look for sell scenarios. Interest rates at this time should be moving lower, okay, because the market will shun lower yields. If the interest rates are dropping, that will indicate that there is a risk-off scenario. And if there's a risk-off scenario, it goes without saying that the US dollar would be strengthening at that time. Treasury notes on the daily chart should be rising, and again, because there's an inverted relationship between yield and the futures market, the interest rates yield will be moving lower while the futures daily charts on the 2-year, 5-year, and 10-year should be rising. Commitment traders report the net positions should show commercials net short and or aggressively increasing short positions, and you find that with the referencing of the open interest. Sentiment should be overbought, and again, it's based on a Williams percent R basis on a daily chart, and we'll talk more about that when we start going into the actual analysis. And obviously the stock indices should be soft or to bearish on the daily chart, so your NASDAQ, Dow, and S&P indices should be topping in here and or trading at key resistance levels respectively. Commodities at this point should be bearish, and we would be referencing the CRB index again as well, hopefully looking for some kind of topping formation, key resistance levels, or some rejections at the highs, indicating that it is now soft and or trading bearishly. And again, referencing the gold and oil benchmarks for the economy should be soft, maybe resistance in both those markets as well, seeing softer prices and maybe to as much as bearishness to facilitate further confidence in a bearish market condition. Okay, the anticipatory stage for this example plan. Obviously, we always begin with identifying the higher time frame, monthly, weekly, and daily key support and resistance levels, because those levels are going to be the catalyst for us looking for signals. So without these levels, okay, we're not going to be taking a trade. So we must have a higher time frame, monthly, weekly, or daily key support and resistance level to facilitate a trade. Okay, so we're going to be waiting for these levels to be traded to. Now, while we're waiting for a setup, okay, when we're seasonally speaking bullish, okay, you're going to be stalking the yields, okay, the yield triads. And I'm going to refer to basically my favorite pairs for this plan, that being the fiber, Euro USD, and the cable, British Pound USD pairs, okay, because they are crossed with the dollar. If we're seasonally speaking bullish, okay, what we're going to be looking for is the yields, okay, 5-year, 10-year, and 2-year, between those three interest rate yields. If one fails to make a lower low, okay, that's going to be a positive divergence, indicating there's a possible turn in yields, and that may indicate a possible increase in yields, which would cause a bullishness and a risk on scenario. Okay, if we are seasonally speaking bearish, okay, and we see the yields between the US, the German, and the UK countries, yields fail to make equal highs in their yields, okay, that's a yield triad divergence. Okay, and we'll talk about that and we'll show examples if it's not very clear to you here, but that would indicate a bearish stage in the marketplace overall. So we're anticipating that to unfold. Okay, at the same time, we would obviously be hunting the same scenario with the US dollar index. Okay, we would be looking for the lows in the US dollar index versus the highs in the cross currencies. Okay, and again, we're looking at the euro versus the dollar and the British pound versus the dollar. So if we're making lower lows in the dollar but failing to make higher highs in one and or the both fiber and cable, then that is a USDX SMT divergence. Okay, and that would be bearish for the euro and or cable if the dollar was making lower lows and the euro or fiber, euro or cable was unwilling to go higher. That's weakness. They should be confirmation between the three. If the dollar makes lower lows, that should be seen with higher highs with the fiber and cable. If there's not, there's a crack in correlation that may indicate something. Monitoring highs in the US dollar index versus the lows in the cross currency pairs, okay, fiber and cable. If we see higher highs in the dollar and a failure to go lower in the fiber or cable, again, that's an SMT divergence for the US dollar index. And that may be a crack in correlation that may indicate something. Now, this can also reverse itself. If you see higher highs in the euro or cable, but a failure to go lower on the lows on the dollar index, that is the same scenario. That is bullish for the dollar, which would indicate bearishness for the euro or cable. And again, this has to happen at a key resistance level for it to be bearish for the cross currency. Okay, the dollar index may be trading down to a support level and make a higher low when the cable and fiber maybe made a higher high. It looks bullish on their charts, but behind the scenes you can see that there's actually strengthening going on at a key support level for the dollar index. And again, same thing happens if you reverse it. If the US dollar index fails to make a higher high, while the lower lows that are seen in the cable or fiber are met equally. In other words, there's lower lows in the cross-currency euro or cable. There's a crack in correlation as well. So you have to compare the highs and lows between the three, okay? And that'll also segue into the correlated pair SMT. You're going to be looking for the lows between the pound and the euro, okay? So though generally they move in tandem, if we see trading at a key support level and one fails to make a lower low, that's a correlated pair SMT divergence, possibly indicating there should be a short-term shift in the marketplace for a bounce higher. And obviously comparing the highs at key resistance levels, if the pound and euro fail to make equal highs, that's a correlated pair SMT, possibly indicating some distribution in the marketplace, and there may be a short-term shift in the marketplace lower. We'll be watching the stock market indices, okay, looking for SMT divergences as well, looking for the Dow, S&P 500, and NASDAQ Composite Index to comparably make higher highs and lower lows. If we're bullish and we're in a bullish environment and we see the Dow, S&P 500, and NASDAQ trading lower in tandem, and eventually one fails to make that lower low at a key support level at a time frame when everything else is lining up, that is a stock market SMT divergence. Okay, so we want to be seeing confirmation. We want to be measuring on a daily basis, monitoring the overall risk on and risk off scenario. So using Dow theory, essentially, we want to be looking for these three averages to confirm higher highs for continuation on the upside, and or looking for continuation and confirmation between the three as they go lower. There should be lower lows between the three. If one starts to buck that trend at a key resistance or support level, there's an indication that you may have to pay closer attention, because it may be something setting up, or if you're in a trade, it may be indicating it's time to tighten up some stop losses and take some profits, or even exit the trade. Again, referring to the commitment trader's net position, we're going to be looking for long positions when the commercials are net long, and obviously looking for shorts when the commercials are net short. Looking at the overall trend of where the commercials are trading on the weekly charts using the commitment trader's net position, you'll be able to see where they're trading in terms of a long-term macro trend, and we want to be getting in sync with that using the COT and higher time frame key support resistance levels. Open interest we've discussed this in other modules, and obviously we're not going to beat it to death here, but basically it's when we're in a bullish condition and we're trading at support, if we see a 15 to 20% drop in open interest, that is a very, very strong indication that a buy signal is either forming and or it has formed, and it's bullish. In bearish conditions, when price is trading at resistance and we see a increase in open interest 15 to 20% or more, it doesn't have to be just 20%. It may many times be even greater than that in terms of an increase. But you want to see it rapidly increase, and you don't want to see a gradual increase. You want to see a rapid increase, and just as well as you want to see an increase, when it drops for bullishness, you want to see it rapidly do that, because that's an indication that the commercials are really, really adjusting positions and allocating funds to offset the initial risk or risk on scenario that may impact the market they're actually working within. So if you see an increase in open interest at a resistance level, that's bearish. Market sentiment, obviously we would be expecting sell signals when we are at key resistance levels and overbought based on the daily chart. And we would be looking for buy signals when we're at key support and oversold on the daily. All right, the execution stage, obviously, again, referencing the monthly, weekly, and daily key support and resistance levels. We're going to be determining, before we do any trades at all, we're going to be determining that specific moment. Are we on risk or off risk for that particular day or that session that we're trading? If we are risk on, obviously, your buy scenarios are a go. If we are risk off, your sell scenarios are a go. You want to be referring to the daily buy and sell programs. Okay, and that means, are we trading off of a key support and off a swing point formation on the daily chart? Because that's what you need for buys. And if we are in a sell program and we see a swing high forming at a key resistance level, okay, that's an indication that we are in fact a go for risk off scenario and daily sell program. Okay, so that has to happen for us to be confident with our trading for this style of trading. When we have that scenario in effect, you're going to be transposing those key levels from the higher time frame, monthly, weekly, and daily, down to your lower time frame, 60-minute, 15-minute, and 5-minute charts. You're going to wait for price to trade to those higher time frame key support and resistance levels. You want to only be trading in the direction of the market structure that you find that's on the daily chart. So your market structure is going to be daily basis. Okay, you're not looking at market flow on 1 hour charts, 4 hour charts. You're only trading in the direction of the market structure that you find on the daily chart. You're using optimal trade entry. Now, this point here, you can use any trading pattern of your choice. If you like the reflection pattern, you can trade that. If you like MACD divergence, this is what you would use here. If you are type 1 bearish divergence for stochastics, that's the pattern you would use here. If you like turtle soup patterns, that's the pattern you would use here. Okay, but you have to trade it at a lower time frame at a key support resistance level in the direction of the market structure on the daily chart. Okay, so the plug and play aspect here is you can use any entry pattern that you want, but it has to be in conjunction with the things that we've already discussed so far. Okay, entry ideally should be traded in a major session open. Obviously I don't have it here. Asia could be one. London and New York open are good because they're just good times to be trading higher time frame setups for the fiber and cable. But if you're a yen pair trader, or if you're an Aussie trader or a Kiwi trader or something like that, you could trade your positions in the Asian session opening, okay, because those currencies have a lot of activity during those times of day. So if you are a Aussie, Kiwi, or yen trader, obviously the Asian session would be a session that you could be utilizing for higher time frame intermediate term trades as well for entry. Our entry orders are going to be based on limit orders, and we'll be keying off of the 62, 70.5, and 79% retracement levels on the fibs to arrive at our entry points. And every one of our trades will always have a maximum risk of 2%, never more, and ideally, less. If we take a loss, we reduce the risk as we go through. If you don't know what I'm referring to, go to our video for handling losses, and it gives you a program how to apply risk reduction procedures in terms of how to preserve your equity. And it's always good to have that, not always walking into the marketplace looking for exponential growth of your equity. You always have to have a shield, and you're going to have losses. You're going to have a string of losses. So this this example is not exempt from that. You will have losses if you use this. Okay, and again, I'm stressing this. Use this in a demo account. Okay, you determine if you have the capabilities to be a trader using this as a model. Okay, it will help develop patience. It'll help develop anticipatory skills as a trader, but you won't have a whole lot of trades. Okay, but it teaches you the concepts and the processes that's needed, because if you can understand how to do this, all of the aspects of trading on a short-term basis, short-term trading, day trading, scalping, if that's what you want to do, those facets of trading will be far easier if you understand this higher time frame premise where you have that major tide in your favor. Okay, it's kind of like a fish. Okay, if you're a fish in a stream, okay, what's easier, if you swim downstream with the current, or if you swim upstream? Okay, obviously it goes without saying it's easier to swim downstream. There's a fish, it's a salmon. It's one of the strongest fish in nature. It actually swims up current, okay, and leaps up out of the water and scales over rocks and everything. And a lot of folks that know that will say, I can be like that salmon. Okay, I'm going to swim against the current, and I can prove how strong I am, and I'll be a contrarian trader every single time, and never try to worry about getting in sync with the overall tide. And that's fine. Okay, granted, you'll probably get to where you're going, but if you're using the salmon as an example, you might want to recall also, when the salmon gets to where it's got to go to fertilize those eggs, it dies. So I mean, it's good that you get there, but if you're exhausted and you croak, what good is that? So you want to be having things majority in your favor, and trading with the tide. Okay, that's what your focus should be. Okay, and trading on the higher time frame premise, using an intermediate term time frame, your short term day trades and your scalps in that direction also will have very, very immediate feedback. You'll know right away if you're going to be profitable in the trades. You don't get that lackadaisical price action you usually get when you're trading counter trend. Stop loss orders obviously always are going to originate at a 30 pip stop from our entry point, and obviously whatever your entry price is, just take 30 pips from that, above for shorts and below for longs. First profit is always going to be taken at 50% of our position at 30 pips profit. So in other words, once the position goes to 30 pips profit, we take 50% of the position off, and once we get that, our stop loss moves to a break-even status. Okay, so now we're in a risk-free scenario. Okay, we've already profited, we got half the position off, so basically we're making 1% on the trade. We're locked at break even. We cannot lose anything. We've already made and booked 1% profit. The remaining balance of the trade, you would look for targets based on Fibonacci extensions, 127 extension and 162 extension. Or I don't have it listed here, but you can have the 200 extension as well. Now you have 50% of your remaining position. There's a couple ways you can handle that. If you are uncomfortable and you're still learning, my advice would be to take 30% off when it gets to 127 extension, and then take 10 more off at 162, and maybe even another final 10% off at the 200 extension. Or take 30 off at 127, take 20 off at 162, and just paper trade the remaining portion. You don't have any open position, but then see if it goes to the 200 extension. Okay, but really the 127 and 162, you want to have at least 70 to 80% of your trade already in profit, and then if you have a small portion, obviously you can leave that to ride to 200% or even greater. Okay, but you want to be taking profits and book them at 127 and 162 of the swing that you're trading. Okay, let's look at the 10-year T-notes and how we can use these in conjunction with yield analysis. And what we're looking at here is this is March, April of this year in 2012 going into spring. And we have a weekly swing low formed at the 128 big figure for the 10-year T-note. It's the US 10-year T-note. Note also that we have a old low here just above the 127 figure, and we have a rally up to the 132 figure, and then we saw a decline down into March, where we had support found at 128 big figure. Now that's an optimal trade entry. Okay, so if we see a swing low on a weekly chart on a 10-year, and we see a pivot or swing low form at a big figure like this, 128, we also see open interest declining. Okay, you can see at the bottom here the purple level here, how open interest was declining. We would expect prices to rally up. Now, if the T-note's rallying up, that means that the yield is going to be dropping. And if again, this is what happened later on going into the year, we saw that spring rally up, seasonally speaking. That is an inverse relationship between the bonds, okay, bond yields. So as the March low was formed and we rallied up into May, June time period, that was going to be mirrored in the yield, okay, dropping. So if the T-note's rallying up, the yield itself is going to be declining, okay? So that's going to be bearish. It's going to drag um, risk out of the market, okay? In other words, the risk off scenario will unfold. Okay, there will be a flight to quality, and during this time frame, we would see the dollar index rally, and obviously, um, risky assets in foreign currencies and such, they would be declining. Okay, so we have seasonal tendency. We see the support and concepts that we utilize in all of our trading. Optimal trade entry, trading at a key support level. We would expect a rally up in this time frame. Okay, April, May time period going into the June months. Okay, let's see what happens in the 5-year T-note. Same scenario. We see a weekly optimal trade entry trading down at the 122 big figure. We see a swing point low, okay, going into April. What unfolds, obviously, much in the same capacity we saw in the 10-year, the 5-year rallies up into the end of May, early June, okay, and even higher in the case of September of this year. But we saw the shift that takes place with a bullish move going higher in the treasuries and the T-notes. Now, if the futures contract's going higher, again, you got to remember their inverse relationship. That means it's going to see a decline in the yield. So we see dollar up, because dollar's going to be trading in pretty much the same direction that the treasuries are going to lead it. Many times the dollar will lead treasuries. Okay, it's vice versa. It's kind of like one follows the other. Okay, but you want to add the seasonal influences in the time of year, like when we trade intraday, we have time of day theory. We have time of year theory, where we see a spring decline or risk off scenario. Okay, and you'll see the dollar increase and bonds rally. So what does that look like in the yields? Okay, what we're looking at is a bond yield triad. And what we're looking at specifically is the 5-year U.S. Treasury T-note, the UK 5-year bond yield, and the German 5-year bond yield. And how I got this chart, I went to Bloomberg.com. And if you go actually and do a Google on 5-year U.S. Treasury government bond yield. Okay, and click on that, and you'll see the Bloomberg link. Do the same thing with a UK 5-year bond yield, Bloomberg. Put that in your Google search, and obviously do the same thing with the German 5-year bond yield, Bloomberg. And when you Google that, you'll get the link for it. Click on it, and when you get the chart that opens up similar to this, you'll just simply add the symbols you see here. For a 5-year U.S. Treasury or T-note yield, it's USGG number 5 YR :IND. For a UK 5-year bond yield, it's GUK G5 : IND. And for a German 5-year bond yield, it's GDBR5:IND. Now, what I want to draw your attention to real quick is if you look at the darker orange color, and I can't pick the colors, it just does it by default. But if you look at how in March, April, okay, the U.S. Treasury was able to make a higher high in yield. Okay, in other words, it would have went lower on the T-note. The green level yield, that's the UK, it was able to make a modestly lower in comparison in terms of the highs made in the US. Then we see the German was also weaker as well. Okay, so it wasn't able to go lower in its futures contract, but the yields, you can see the disparity, the shifting in place that takes place where the U.S. Treasury 5-year went higher. So we have a SMT divergence, okay? There is a confirmation that there is a weakness underway going into April. So we see that weakness translated in the form of these overlays. If you take the UK off, okay, so now we're just looking at the German 5-year and the US 5-year. You can see a little bit clearer now that the green level, green, is the German, and the orange color is the US. US was able to make a higher high in yield, while the German was unable to make that higher high in going into March, going into April. So we see a slide lower in yield, and that was translated in the rally up in the T-note that we saw in the U.S. Treasury. So there's this symmetry between the two. You want to be watching the yields, you want to be watching the T-note, you want to be watching the German yield with the German futures contract. You can trade the not trade, but you can track it with its futures contract and the UK as well. Seeing these divergence, okay, adds confidence to your expectancy that we should be seeing weaker British pound and fiber prices and a rally in the dollar April-May time period when the spring seasonal influence should be coming underway. Now looking at the US and the UK, you can see that same thing happening. The orange level, that's the US, and the green is the UK 5-year yield. We were unable to make that comparable higher high in the yield in the UK, so we see the SMT divergence that we would expect to see going into April. So we saw further evidence by removing one. You can, it's a little bit clearer, you can see it, divergence between the two yields. And by looking at just simply the UK and German yields, you can see that the German and UK yields were not able to make comparable highs. Between December and the middle of March, the UK was able to trade higher. At the same time, the German was weaker, okay, and was unable to make a higher high in yield. And you've seen that also going into the actual price levels that the fiber itself was trading, because that's what the German's going to be measuring, the yield for that specific country. The UK is for the cable. Well, if you look at the underlying weakness that was in the yield for the German, you can see how we were really, really weak, really soft in the March-April time period for the fiber. So there was really no participation whatsoever or interest in chasing any higher yield there. They were actually selling into that, and you could see the weakness really accelerate going into June and the middle of July. Okay, folks, we're looking at barchart.com. Okay, this is a free website, absolutely zero fees whatsoever. This will give you access to commodities and commitment of traders reports and open interest. When you go to the home page, this is what pops up. You just go over here to this little tab here. It says select a commodity. Tap that, and we'll start with the US dollar index.